If you invest your money into an annuity and you're going to turn on the income in a few years, does that mean that you have all of your eggs in one basket, that annuity? I'm going to answer that for you in just a second. Stick around. The more information you know about investing, the higher confidence will be. So learn as much as you can. I just want to let you know that I did write a book called Investing Your Way to a Happier You. It was the #1 bestseller on Amazon. And this is a really good book to learn about basic things like stocks and bonds. And I made it very unboring. I have like diagrams, pictures, a lot of pictures in here, not that much reading, but it's very easy to understand. And so I just highly recommend that you look for this book. It's on Amazon if you really want to increase your learning around investing. What does it mean when you say, I have all my eggs in one basket? What that means is that you either put all of your money into one stock, you put all of your money in one mutual fund, maybe you have all of your money in one bank, maybe you have all of your money in one, bond. And generally speaking with investing, you're not supposed to put all of your eggs in one basket. You're supposed to have everything spread out. And that's important. It is a very important part of that. When that is said, there's all different kinds of annuities. But I'm going to talk about how to withdraw money out of them. When I'm preaching about income, I'm always talking to people who only have Social Security. If they only have Social Security, I recommend they get a second stream of guaranteed lifetime income. The first way you can take money out of an annuity is called annuitization. Now, bear with me. It sounds like it's complicated, but it's not. What happens is you put your money into the annuity, and then whenever you annuitize it, you freeze it. It freezes that money. And then you get payments coming out every single month forever until you die. That's annuitization. The other type of withdrawing money out of an annuity is when you have your money here, it's in an annuity, it doesn't freeze, but you start getting payments every single month until you die. Your money isn't frozen, but that's what happens, okay? One thing that's really important, like I said, I've worked in banks and credit unions, and I've always, as a financial advisor, that's where I've always worked, in that space. So I work with a lot of savers, and these people, they have worked very hard for their money. And the last thing they want to do is lose their money to the stock market or to anything. So again, I'm used to working with savers. So when I say put your money in this annuity, you're not going to lose your money. And I mean that. And the way that I mean that is that every state in the United States has a guarantee limit, like a guarantee association. And it's similar to FDIC insurance in a bank. Now, FDIC insurance in a bank means that if the bank is out of business, you'll get reimbursed, I think it's up to $250,000 for each bank. That's what FDIC is. And it's similar with annuities. Within every single state in America, there's a limit, a guarantee association limit. In South Carolina, it's $300,000. So if somebody puts money into an annuity and the company goes out of business, then the person will be, reimbursed up to that limit. So $300,000. Whenever I meet with people, we always make sure that whatever they invest in their money in, that we never go over those limits, no matter what state you're in. But what we can do is we can put it in different insurance companies. So we don't have to put all of it in one thing. So that is always a top priority. So we're never going to just put all of your money in one insurance company. We're going to look at that state guarantee association limit for your state. We're going to make sure we don't ever go over that. Then we're going to make sure that we put your money into the best insurance companies that have the best interest or the best payout rate for you so that you get as much money as you can safely until you die. So that's what we do with that. Now, with that being said, the way to get the best income is putting your money into an annuity with an income rider. Your money goes in and it grows a lot. And then at one point, you turn on the income. That income starts and it never stops until you die. What's important to know about that is that type of annuity, we know that you're putting your money in, you know that whenever that income starts, you're looking forward to that. And you know that amount and you're depending on that. And that's what you're excited about. And that's why you're investing your money. That's important. What you wouldn't do is let's say you put in $500,000 into an annuity. You're going to wait like 5 years for that income to start. You know that money's going to be growing a whole lot so you can get that income starting. But you would never want to go into that $500,000 and get like $20,000 out and buy a car. Why? Well, because if you take that out, then it'll reduce your monthly amount. So we don't ever want to do that. So we kind of act like that's not there, even though it is there. But your money will pay you for life, and that's what's most important. Whenever someone invests their money too, again, I do focus a lot on safety because, again, I've always worked with bank channel, and those people are savers, and they don't like losing their money. So that's who I work with the best. Those are the type of people I can help because they don't want to take a bunch of risk, and that's how I'm used to helping people. So the second thing would be, when you get an annuity, we all know that you put your money in and then you're going to get payments until you die. And that's a huge benefit. You're getting your own pension. You have to leave your money in for some time. It has to stay in there. It has to grow. But one thing is, yes, you're putting your money in an annuity, but listen, you are not going to ever put in with me more than half of what your cash is. Now, I'm not talking about your house or your equity in your house. I'm talking about your checking, savings, CDs, IRAs, investments, 401k, cash, money that you can get to easily. That money, you can use half of that, maybe a little bit more than half sometimes, but then the other half of that money, you're going to need other money to be available for an emergency. Okay. So that's why we do that. And there are people that are like, but Tim, I want to invest more. Why can't I invest more? And lots of people say that, not just that. It's hard to explain it, that you just need emergency money. When you invest money, like I said earlier, you don't want to have all your eggs in one basket. That's very important. With Social Security, when that starts, you're not ever thinking to yourself, let me go get some money out of that Social Security. No, you're not, right? Because it's an income stream that you're getting. So you're not ever thinking about where that money comes from. And then you're not going to try to go into it because it's not like that. It's not an account where you can just pull money out and pay for your new home renovation. Okay, that's just not how it works. It's income. And so what we would be creating for you with an income annuity would be income. That's very different than having money in an account. There's two different things. There's called income and then there's asset. Assets are basically any money that you have that's sitting in an account somewhere, in an investment, checking account, savings account, whatever. That's your asset. They're two very different things. They're both important, but they're different. Like income would be like a house, and then assets could be maybe like a car. I mean, they're important and we need them, but they're different. The reason that you're not putting all your eggs in one basket when you put your money into an income annuity is because you're converting that money to a pension. So it's not going to be like a stock or money. It's not going to be like that. It's going to be a pension coming to you. And that's what it will be, is income. Any money that you don't invest in that, like I said, you have to take about half of your money, put it to an annuity, no more than half, usually. It just depends though. But that other half of that money, that is important. That needs to be spread out. It doesn't need to have all your eggs in one basket with that either, because that is a very important rule. And that is something that we always keep in mind. When you have a chunk of money, you put it into an annuity and you want to get income, you're converting it into a different type of instrument altogether. So it's not even something that you would consider is an asset allocation. Because if you look, like in the book I was telling you about, asset allocation means just like a fancy word for all different types of investments and what their goals are and what they do, right? So you want to make sure you don't have your assets in one class or one thing. That doesn't even really apply to income because, again, a second income stream is just income. That's what it is. And like I explained, it's guaranteed because we always are going to make sure that you don't ever put in more than what your state guarantee association will allow. With the other half of your money, let's say you had $800,000, right? I said the most you could put in is like $400,000 into an annuity, an income annuity, okay? That other money, there's all different types of things we could do. But also remember, I'm helping people come down the mountain. We're going to draw down into that 401k. Not everybody wants to do that, and you don't have to. But I just wanted to be there for people that do want to do that. So we're going to be drawing down that 401k or drawing down your assets. You will have the other money that you did invest. What do I think you should do with that? Well, I think you need to have a lot of that in cash. Now, not all in one bang, none of that. Like, of course, spread out, but have it in, when I say cash, I mean something you can get to if you need it, most of it. And then probably about 25% of it, I would recommend putting it into a growth mutual fund because you're going to still want a little bit of growth. Yeah, there's room for movement within all of that. But to me, I think that's a great thing because you're in retirement. Now you're wanting to spend money, you're wanting to take trips, you're wanting to live, right? And so having it in cash, I mean, you're at the peak of life, right? It's time to spend some money. So I would have a chunk of it in things like checking, savings, CDs, whatever. We're not worried about growing that money right now as much. We were worried about growing that money when it was accumulating, when you were working, bringing in the money. But once you get to retirement, it's time to start thinking about how we will spend that money. I have a personalized income plan for each person that I meet with. So everybody's different. We always talk about what they want to do, make sure that we stay within their values and what is important to them while following a good plan from a financial standpoint. So that's always important. But that other money, we would have it in something like maybe bank, CDs, checking, savings, and then a little bit of that maybe in a growth mutual fund so that it can have some growth. If you put money into an income annuity, Like let's say you did put 400,000 into an income annuity, you're making a big decision right there. You're making a very smart decision, but you're making a big decision. You're making a huge investment. And you know, when you put that money in, it's going to be growing very well until you turn on that income. And then that investment is a big job to do because it's got to pay you money every month until you die. And it might be paying for your spouse as well. So that is always something to keep in mind. I just wanted to tell you all about that because there has been some questions about that. One thing that we can tell is that when someone has money coming to them every month, retirees are more willing to travel, renovate their house, and just like do things for fun and normal. If they don't have it coming to them on monthly, they're more likely to kind of stay home and watch the stock market and not really live as much. That's just kind of how we're trying to help y'all out, is just make sure that you are living a balanced life based on what you want, based on what makes you happy, what your values and goals are. Again, putting all your eggs in one basket means you have all eggs, right? And that matters with money that you have in accounts. But we talk about income, that's an income stream. So that's not the same thing. I would never recommend someone put all of their money into an annuity for income. I wouldn't do that. Half of your money. You would put half of your, up to half, not even half, not even all of it. Maybe we would always have to talk about that. That's why it's a personalized plan. But we would put whatever amount works for your situation into an annuity, but not more than half of your money to your name. So we would never, ever put all of it there. Now, the other money, we would talk about that and figure out what to do with it. Think about people that are in the military. They work so hard for so long. They are moving all around. They make a lot of sacrifices and they have to move their family from town to town, state to state. But they know that when they're like 40 or whatever age they are when they retire, they're going to be getting a paycheck every month forever. And those are not free, right? They had to work really hard. They had to travel. They had to make sacrifices. Their kids had to be upgraded, put into other schools. But they also have a huge benefit that's not easy to get. You can't just get income easily like that. And then that wasn't easy for them. But I'm just saying, it's always, you gotta have some strategy in life. And that is a good one to prepare to, because the military, and we all know how that works. And so whenever they're 40, they really kind of have it made after that because they've got money coming in forever because of all the sacrifices they made before. And again, we see people in the military and they seem so happy. They don't seem as stressed out. They seem relaxed because they have money coming in. And they'll let them get another job, whatever, but they still have that basic income coming in. Right now, people are retiring with only Social Security, and it's not enough. The average Social Security payment is $2,000 a month, and that's not very much. So having some of your money turned into income to help you cover your essentials, your basics, your groceries, your bills, that kind of thing, is something to think about. And a lot of advisors don't focus on that. Especially in the past couple of years, I didn't notice that just a lot of people did not have enough income. And so when I focused on that, they needed it. With the military, they don't have all their eggs in one basket. They have income. That is not the same thing as having just too much in one place. It's just not the same thing. I struggle with ADHD. Growing up, I had a hard time with it, all about that in this book. Let's hear about that. But it's just like, I had to learn different strategies to learn things because it was challenging. I had to figure out how to learn all this stuff about investments and learn that I can just do it. And so I don't like things that are boring. And it's because I have ADHD. And so in this book, I made it a point to make it so that it's easy to understand, but it's not that hard. It is intimidating. It's kind of financial info, but anybody can learn it, really. But annuities, they are complex. And I mean, it's not like you have to be some genius to learn them. It's just, you have to, I think it takes years just working with them to understand the ins and outs of them, that you understand them completely. So I don't think a lot of advisors focus on that at this point. So I'm glad to be in this space to help people with that. So anyway, all right, y'all, thanks so much.